Midas Investor Series with Anne Miracle. I'm co-president Alex Montalbini, MSO8, and founder of Emilio, a real estate development and consulting company to build healthier homes. Thank you for joining Stanford Angels and Entrepreneurs United today. Format today will start with a fireside chat to get to know Anne, followed by a live Q&A. Anne will share her first impression on 3-minute pitches from some founders here. We'll then conclude with announcements. Please note that today's event is for educational purposes only and should not be construed as investment advice nor endorsement. Now I'll hand it over to Sheila for an intro with Anne.
Thanks, Alex. I'm Sheila Pruva, MS in Computer Science from Stanford and a co-president of the group. We are delighted to welcome rockstar investor Anne Miracle. Anne is co-founding partner at Floodgate, a seed stage venture capital firm. She's been one of the first investors in Lyft, Refinery 29, and many other hits. She's earned repeat appearances on the Forbes Midas list and the New York Times list of top 20 venture capitalists worldwide. Beyond her expertise in marketplaces and consumer applications, Anne is known for her highly technical investments. After all, she earned a PhD focused on mathematical modeling of cybersecurity at Stanford. In addition, at Stanford, she's a lecturer in engineering and co-director of the competitive Mayfield Fellows Program, which trains undergraduates to become technology leaders. I particularly admire Anne for co-founding Allraise, an organization dedicated to the success and prevalence of diverse funders and founders. Anne received a BS in electrical engineering from Yale, where she serves on the board of trustees. Welcome, Anne. We're very excited to have you.
Thanks for having me.
Our community would love to know more about you and how you think. So let's start with your investor's perspective. How has your approach to early stage investing evolved over the last 13 plus years?
I guess it's changed and it hasn't changed in many senses. So when I first got started in investing, it turned out that there were maybe 4 or 5 other firms who were really competing with us. And in fact, there wasn't that much capital around the table. And so we would actually share deals with one another. And so oftentimes, I'd write in a check for $500,000 and call it first round capital. They put in another $500,000 and we call baseline, and then they put in another $500,000. And when we first started, the search that we did resulted in 5 firms that were actually practicing our strategy throughout the United States. If you do that search today, there's over 1,000 such firms. And so when I first entered into the market, there was real product market fit. There was scarcity of those resources. And we were onto a secret. And we were able to keep that secret, but because of the product market fit, the word got out and a lot of capital came into exactly the stage where we're investing. And so the game is very different today. In many ways, it's much more competitive. In some really delightful ways, it means that there's a lot more founders being funded with very, very diverse ideas. And also just across the table, geographically very diverse, international in many cases. And so much of what we do today has changed. But at the same time, the actual practice of venture capital hasn't changed that much. And that's sort of for better and for worse. At the early stage, I think what I've realized is that there are many different stages for venture capital, right? And most people think about it in terms of pre-seed, seed, A, B, C. They talk about it in terms of the name of the round. They might talk about it in terms of the dollar amounts raised, when in reality, it's actually much more like stages in life. Someone might be 25 years old, but they might have a totally different maturity profile from another 25-year-old. It's the same way, actually, with startup companies. So you could say they've raised $5 million, but it doesn't mean that tells you something about whether or not the company has product market fit. We've seen companies that have raised $100 million and still doesn't have product market fit. So as a result, what I do, I spend a lot of time trying to figure out how to help companies get to product market fit. And over time, our frameworks for assessing that have really become refined. And what we spend time on with our startups, and then what we refuse to spend time on with our startups, has become much more refined.
On that note of the variation in startups, what top traits do you look for in the companies you choose to invest in? Do you focus on areas, ideas, people, or traction?
So, this is going to be kind of an unsatisfying answer, so I'll try to put a little bit more of a fine grain on it, but it really depends. So I believe that certain startups will have a center of gravity, which is very technical. And the thing that really allows that company to succeed is some secret that they have. Maybe it's a technology secret. Maybe it's a secret that they have about the way the industry is evolving. And you're building your company based on that moat. In that case, what we're looking for is really an assessment of that insight. If you don't have that, then really what we're looking at is an assessment of your operational capabilities, which is only shown in actual practice. So you could say you're really operationally excellent, but we need to see numbers in order to prove that out. So when we look at companies, we're looking at what is that center of gravity. Is it there's not really a secret, but man, they really know how to execute? In which case, oftentimes we are looking at early signs of life of that business and we're looking at some level of traction. But in other cases, we're really assessing a secret. And sometimes we're assessing just the two founders that are in place. And so depending on what you have, it might change fundamentally what we are looking for within that team or within the idea.
Now, Floodgate only invests in 3 to 5 companies each year. Where
Each partner invests in
yes. So where do the 6+ companies, especially the ones that get really close, fall short?
In any of those cases, right? So I'll give you an example. One company we just did 2 weeks of diligence on and just passed on. Loved the founder, thought that this person was extraordinarily capable, especially within the vertical that they were pursuing. They were very technical, but they were kind of missing a go-to-market person. And it turned out we felt that the go-to-market was very, very important because their act one of their business was pretty obvious, and they were going after a market that this founder knew really, really well. But that market in and of itself wasn't big enough. We couldn't convince ourselves that that could be the basis for a multi-billion-dollar business. And so we needed to convince ourselves of what Act 2 and Act 3 would look like. Well, the Act 2 and Act 3 that were being presented were a little bit fuzzy, and we couldn't figure out what was a natural path from Act 1 to Act 2 or Act 3. And because of that, what we would need is actually confidence in the team that they would be able to figure it out and iterate their way there. Well, without that go-to-market person, it was really hard to put that picture in our head. And so as a result, we were left with a little bit of a hole. And we felt that actually we needed to have proof points about that next act before you could even raise the next round of financing. And because of that, as we look down the path of what is this company going to need in order to get to that next stage, we didn't feel as much confidence. And so we ended up passing. So that gives you color on exactly, it's very dependent upon the company. And we're really trying to assess the path. And we're trying to see sort of where is that future that they're driving towards. Part of what was attractive about this company was it really fit into a specific thesis that I have around healthcare. We were looking at what I generally call Shopify for healthcare. And so we're looking for ways in which new startups can be created in the healthcare verticals in really easy ways. And this was such a company. And so we were first looking for something that actually fit that thesis. Once it did, then we were assessing both the founder as well as the path of the company and how realistic we felt that it was in being able to achieve real greatness.
How do you help teams go from idea to product, getting from one act to the next? What role do you and your team at Floodgate play?
We're very active in working with our teams around what it means to get to product market fit. And so in our initial stages, we have extensive conversations about what it means to have product market fit. What are the metrics that we need to see? Why are those the metrics that we need to assess? What are the general values that we think we might be trying to target? And what we're saying is there's certain qualitative aspects of product market fit, and then we also think there's quantitative aspects. So what we say is, here's the story that we want to be able to say. In 12 to 18 months, this is what the business ought to look like. And these are maybe the 5 great claims that we want to be able to make. Well, when we backtrack from that vision, what do we need to prove out in 12 months? What do we need to prove out in 6 months? What does that mean we need to prove out in 3 months? Both from a qualitative but also quantitative basis. We try to work through those things, and sometimes it can be that, you know what, all of those metrics or the vision for what we thought we had was fundamentally different and it's changed now. Well, then we have shorter period of time to get to that vision, and we have to redraft what that vision might look like. That's what we really help out with if a company has raised a seed round. If they're a pre-seed, oftentimes they're iterating through products. And so our job is actually to say, this is really not going anywhere and you should drop it. Or we'll say, hey, you know what? This has signs of life. And so you should really double down on it. And oftentimes, I'll work with teams and meet with them, maybe depending on where they are with their product milestones. Some of them I'm meeting with every other week. Some of them I'm meeting with monthly. Some of them I'm meeting with them every other month, because it takes some time for them to get through the iterations. And what I'm trying to do is match up to in my mind of like what their talents are and whether or not they're getting closer or further away, or if they're stuck. And I feel like my job from a venture capitalist perspective is to give them that high level view of, you're stuck and you feel like you need to keep going with this product, but it's not going to take you where you want to go. Scrap it and start over again. And it's okay to do that. Or when the data isn't totally clear, to be able to come in and say, I have high confidence that you have something here because I haven't seen anything like this before. Let's keep going. And so it's knowing when to be the cheerleader and also knowing when to tell them to cut bait.
Think back on your favorite founders. Who comes to mind?
Let's see. There's a couple that I think have been on a really interesting journey and have had incredible persistence. One guy, this guy's Alex Ma. He's the founder of a company called Paparazzi, which for 3 years was on sort of this, they were sort of out in the wilderness, sort of searching for product market fit. And in the consumer space, that's just extraordinarily hard. And he must have gone through, 5, 7 different products. And finally, he hits upon this one product. And it was sort of at the end of year 3, if you can imagine. 3 years of not having product market fit. And finally, there's this one product that shows signs of life. And in this huge flash, like they launch, and it was this incredible launch where tons of people, like my daughter and her friends, were downloading this. And what I love about Alex is he never lets either the failures or the successes sort of blind him. And so even in the moments where things looked awesome, he was looking at it with a very analytical lens. And he wasn't buying into this like extraordinary success. He just knew that there was going to be a lot more work. And so, I think in my mind, Alex is sort of that quintessential entrepreneur that you want to see him win, but also you just have the chance to work with once and you just know that this person is special. I'm confident that he's going to figure it out. And so I'm a huge fan of his.
Great. So now, Anne, taking the founder's perspective, how should an entrepreneur evaluate investment from angels versus institutional venture capital investors?
I think fundamentally, you're always taking money from an individual, right? And so in my mind, people, when they come and take money, like a check from me, in some sense it's floodgate, but it's more Anne. And so I would say no matter who you're taking money from, do your diligence, ask people how they've been helpful, figure out if this is a match, figure out if they will push you in the ways you need to be pushed, or if you want to be left alone, if they'll leave you alone in the way you want to be left alone, because not every investor is a great match for every founder. I really believe that. And so in my mind, like the win happens when I'm a great match for another founder. It's not pleasant if the founder, like in my case, if the founder just really wants a cheerleader who wants someone to tell them how great they're doing, I'm probably not the right person, because I do love to push. And so I try to be clear about that with the people that I work with. Unfortunately, because I don't make that many investments, and oftentimes I do a bit of diligence on companies, we have some time to get to know each other. And I would encourage most founders to try to go through that process, to have the chance to get to know someone before you take money from them. We like to say, it's easier to go through a divorce than to divorce one of your investors, and particularly someone who's invested quite a lot of money into the company. I think is one that you really do want to understand better, like what are they looking for and why.
Given the shortage of talent right now, particularly engineering talent, how important is fundraising from a well-known VC or investor to attract the talent?
I feel that it is important, but at the end of the day, some of our investments that just are killing it, like that's what actually ends up making the difference. In fact, like one of our companies, the big argument that we make is they don't need to fundraise. And as a result of that, from an employee's perspective, you're not going to get diluted. So on one hand, sure, like a big name fund comes in and invests some money into the company. Those are the companies that tend to actually raise a ton of capital along the way. And so from an employee perspective, maybe you get to go and tell your friends that so-and-so invested in your company, but the amount that you own at the end, the wealth creation that happens is significantly diluted. I have one company that's gotten to over $1 billion in valuation and has raised less than $10 million of capital before they got to $1 billion valuation. That's the company you want to work for, right? Because your shares never really got diluted along the way. And so what you owned at, $30-40 million in valuation is pretty much what you owned at $1 billion valuation, versus a lot of companies are raising 50, 100, $250 million to finally get to that point. That means you're diluted 30-40% before you even get there. That's a huge multiplier effect that you've lost. And so in my mind, that's what you want to look at. You want to look at how capital efficient this business is going to be, because it's going to have a huge impact in your own personal wealth creation, even if the company is wildly successful.
Yeah, that's a great perspective, Anne. Now, how do you think about long-term goals and aspirations, particularly as our world evolves more rapidly? And what's your North Star?
So my own personal philosophy, I within Stanford, I'm teaching not only in this leadership program and within Mayfield Fellows, we have a big emphasis on ethics and entrepreneurship. And so a huge point for me is not just, creating a future. I believe the best founders actually dream up a future. They're not just projecting the future from the present, and they literally bend the curve of the present trajectory towards the future they want. And so what I'm investing into is a future I want to see. And I think that's a really important piece of really thinking about the startups that you work with, and the startups that you invest in. Like, what does that actually turn into, and why? My old co-advisor to my PhD program is John Mitchell, and he's the chair of the CS department. He and I got the chance to teach a couple of years ago a blockchain class at the D School, and we called it "So You Want a Revolution." And one of the lectures was really around asking the students, how could this revolution go wrong? And most of the time they talked about lack of adoption. And I think John and I had to say, wait, that's not what we're talking about. We're asking you, what if everything you thought was going to happen didn't happen, and rather the things that you built were used for a purpose that you didn't intend for it to be used for? And it was surprising to me that the students didn't immediately go there. And it's something that's really stayed with me. And I feel like it's something that we need to always actively teach. It's something that we have to keep in the minds of the founders that we're working with. And I do talk to our partnership about, is this a world we want to run to or not?
So now it's time for the live Q&A. What are the top 2 or 3 red flags that make it very unlikely for you to invest in a company?
This isn't really a red flag, but sometimes it's just not a fit. I'm actually pretty narrow in the areas that I'm currently looking at investing in. And so it could be a great company, but it's just not a fit for me. In terms of actual sort of red flags, I would say number one, we are looking for a team that actually matches the opportunity. So as I was saying, like, sometimes I think there has to be a great go-to-market person, or sometimes I feel like the technical team isn't quite strong enough. And so I will be looking at the team to see if they can execute on the early pieces of the vision. The second, I would say, probably the more usual thing that causes us to say this isn't a fit for us is that the market feels too small. And a lot of times, like, a founder will go ahead and say, well, the spend in this area is, X gazillion dollars. But they haven't gone through the bottoms up sort of assessment, either of like, how easy is it to get through that bottoms up? Is it a crowded marketplace, or is it, you're the only player, and so therefore, even though it's smaller, you can capture most of the market? So they haven't thought through, like, how big is this market relative to the competition, and how crowded the marketplace might be. And so as a result, it doesn't feel large enough. Oftentimes, if we've seen like 5 or 6 other companies in the exact same space, it's highly unlikely at that point that we're going to make an investment as well. Unless you have something, like, something that is actually quite surprising and makes you fundamentally very different from the other providers out there. Those are the most likely reasons we end up saying no.
If you were just getting started with angel investing, what advice would you give yourself?
I think it just depends on, like, what the purpose of angel investing is for you. Some people are angel investing because they want to support their friends and they want to, be a part of sort of this technology ecosystem, in which case it really is just about having fun. The second piece is, if you are doing it for real returns, it's oftentimes hard to underestimate how much ownership and valuation really matter. And so most of the time, we're seeing just a lot of discipline around valuation. but every time the valuation goes up significantly, you're losing multiples. So when we first started at Floodgate, most of our investments were happening somewhere around $5 million in valuation. And that's really crept up to somewhere between 10 and 20. Early, like our pre-seed investments are still around 5 to 7. But our core seed investments have crept up to somewhere between 10 and even $18 million in valuation. And right then and there, we've lost a 3x multiple. And so that's a really big part of how we think about how we make money. And so if you say like, oh, what's the difference? It's like, $30 million valuation. Well, if you compare that to what we used to invest at, you've lost a 6x multiple. And so that's pretty tremendous.
What kind of character due diligence do you conduct on founders so you're not ending up backing an Elizabeth Holmes or Adam Neumann?
We actually end up doing if it's a technical company, we will do technical diligence. If a company refuses to allow us to do that, that's probably a pretty big red flag. The other thing that we'll do is we do background checks. Now, none of those would have actually picked up on Elizabeth Holmes or Adam Neumann, but I think the technical diligence piece would have picked up on Elizabeth Holmes. I think also with Adam Neumann, it's a hard one because there's a chance that actually the fame and the fortune actually change the nature of the character, and it's hard to see that. Sometimes you'll find that in some of the founders, like the fame actually really gets to their head and suddenly the nature of the person suddenly changed. I imagine that happens a lot with celebrities. And with the celebritification of entrepreneurs, I think you're starting to see that become a little bit more common. But in general, I think, the best way to assess it is really doing back channel referencing. Are they, do they care about the idea that they're working on? Why? And then ultimately, what kind of worker have they been in the past? Are they reliable? Are they hardworking? All those things sort of matter at the end of the day. And then do they have high integrity? Those are things we do ask. And we try to do that back channel referencing before we invest.
We'll take one more question before we'll get to the founder pitches. Now, you mentioned Shopify for healthcare as an area of opportunity for startups to explore. What other investment areas excite you today?
I'm in the consumer realm. I'm looking a lot at curation. We are spending a lot of time in crypto. And so I would call that sort of Web 2.5, the bridges between Web 2 and Web 3. I'm still really interested in scaling and predictability and privacy within crypto networks. And so one of our early investments is Starkware. So that's an area that I do want to build on. And I'm curious about Web 3, but haven't placed any investments there. I'm also spending a lot of time on what I would call curation of things, whether it's products or information or things that consumers care about, whether it's restaurant recommendations, travel recommendations. We're looking at how do you do human curation at scale, and so that's an area that we're looking at. And then I call it sort of tools for SMBs and solopreneurs is also an area that I've been spending some time in. And then the last is healthcare. I talked about Shopify for health. I think sort of text messaging in health is really interesting. And we think that sort of we're trying to figure out free markets. So one area is senior care, like people will individually look for senior care and higher quality senior care. And then things that have to do with children is also an area, children's healthcare is also an area that we're looking at right now. But fundamentally, they're all sort of software plays that we think are interesting.
So now it looks like Ohm is up and we're ready to get your first impressions.
Absolutely. Thank you very much, Sheila. Thank you very much, Anne. SaveAway.net is the startup that I'm the founder and CEO of. Notably, it also counts a fellow Stanford alum as its earliest angel investor. In a nutshell, the one learning that I've had over the last 15 years of being in retail financial services, the single biggest reason for debt is people having credit that's unnecessary that becomes debt. It used to be because of credit cards, and that problem has arguably now multiplied with buying now, paying later. So SaveAway.net is precisely the solution that comes in there. Essentially, we've created a savings wallet for people that don't have credit or don't want credit to still be able to make a purchase. If you're looking to make a purchase of $1,000, you can utilize that wallet through our marketplace, where we have API integrated several noteworthy merchants like Etsy, eBay, Best Buy, among others. Select the merchandise, set up a savings wallet, pay up in installments. Friends and family can both gift towards your goal as well as provide advice. And that behavioral design allows users to save up to make that purchase possible. Without really any marketing, we've had over 17,000 people sign up to use the app. Fortunate to get some critical acclaim from forums like South by Southwest and the American Banker, naming us among the top fintech companies to watch. And we just had the first in our series of patents around the technology stack awarded. And couldn't be more delighted to have you join the mission to Save Away. We just had a icon in fintech invest in the round that we're kicking off.
What is the sort of the defensibility piece?
So I would say the team, the deep insight that I think our team brings. I've been living and breathing in this space for the last 15 years. So it's a lot of those, lessons learned.
And is the business
ultimately, of course,
that you take a percentage of the price, that it's a slightly higher price as a result?
To your point around the revenue model, it's a revenue share between the seller and the SaaS subscription fees. So the service can actually be free the basic service can be free to end users, which is contrasted against most other fintech apps.
I
Thank
think,
you, ma'am.
The main things I would focus on for you is just sort of, there's sort of a defensibility question. And then ultimately, how do you generate revenue more immediately? So a lot of these fintech businesses are actually getting to revenue pretty quickly. And I think that's been the attraction to some of these companies. And so, how do you do that? What's sort of the attractiveness? I love the fact that there's a social nature to it. And that sounds really interesting.
Thank you very much for the feedback. And
next founder, we have Andrew Cox.
My name is Andrew Cox. I recently left my career in banking to launch a co-working dental startup, currently pre-seed, raising funds for a first location. The overarching goal is to make independent dental practice more attainable, more flexible, and more economically viable for independent solo practitioners. The background here, in case you're not an avid follower of the dental market, is that dentists are by and large unhappy with the direction that their industry is heading in. A few different key headwinds, but you have dentists coming out of school with larger and larger debt loads, currently not uncommon to have $250,000 and up coming right out of dental school, $500,000 and up coming out of a specialty training program. And then the startup cost of having a new practice has also grown, depending where you're doing it, $500,000 to $1 million of a loan to start a new practice is uncommon. And so the end result is that having your own practice has become less and less attainable. More and more dentists are becoming stuck as employees at large corporate dental practices and private equity owned group practice roll-ups. The other piece of it is the rapid growth of corporate dentistry, which is putting competitive pressure on independent practitioners more generally, even if they do have their own practice. And it's also allowing the insurance companies to kind of continually decrease reimbursement rates, putting additional margin pressure that the large corporate practices can deal with, independent practitioners not so much. So, you know, my plan is to build out physical brick and mortar co-working locations that make it easier for dentists, even on a part-time, one-day-a-week basis, to start building out their own practice. The co-working model itself is actually a novel but really great fit for dentistry based on my diligence. First off, it lowers the economic barrier to starting to practice. It also dramatically reduces overhead. Normal dentist offices run about 70% production overhead expense. And then it gives you a lot more flexibility on your scheduling as well compared to traditional employment or even independent practice. I'm also looking to leverage a number of innovative tech platforms that, you know, for the first location at least, kind of white labeling a cobbled together group of innovative platforms out there to assist with everything from scheduling, billing, payments, insurance processing to, you know, really streamline the administrative side of dental practice. And I will have on-site office managers as my only non-corporate employees to begin with, assisting with that. Generally speaking, a lot of the recent tech innovations in dentistry have gone underutilized in the profession, especially amongst the independent practitioners. And I think that's exacerbated by the fact that a lot of their pricing models disadvantage independent practitioners, often based on volume or per location. So, you know, everyone that I'm working with from my first location has agreed to any dentist, even if they're using one operatory one day a week, is basically getting the benefit from pricing that would be, you know, bestowed upon a large group practice. The last piece is I'm focused very much on digital and physical design. So the first location that I've picked out is in a nice, I don't know if you're familiar with Denver, but Denver's Lodo neighborhood, which is sandwiched between the business district and a residential district. So, you know, very retail focused, shops, restaurants, lots of sidewalk foot traffic. And I'm working with an interior design shop out in New York. I have a design and project manager that's built out Warby Parker's, Blue Bottle Coffee's, 10 dental locations. On the off chance you're familiar with that dental startup. And so I think by putting a focus as well on the design and branding element, I'm able to better attract dentists who will want to work in a space like that. And then it also helps them attract patients. So maybe I'll pause there. That's a high level idea. Like I said, pre-seed, currently raising funds, just moving past friends and family at the moment.
I really like the idea. I think, you know, I'll tell you why it's not for a floodgate. I feel like with companies like this, and I felt this way actually with a lot of the co-working sort of WeWork type businesses, which was there's a certain element of it which is real estate, right? And if you understand real estate, you could actually really assess this type of business too. There's so the center of gravity is not necessarily purely on the software piece and what the software enables. There's a large kind of risk component that has to do with just the real estate portfolio. And so I've always believed like these types of businesses should exist, but like the type of investor you want is someone who has like that cross feel across real estate into tech. Not someone who's invested in Compass, right? But like someone who really understands how to invest in commercial real estate and then appreciates the software component. Because I think you have the opportunity to create like a really nice verticalized stack around creating these practices. I am a huge fan of talent marketplaces. I guess that's one that I did not mention. Spent a lot of time looking purely at talent marketplaces and how do you ingest people how do you allow people to work the way they want to, right? So allow a dentist to be more freelance, to work one day a week if they want to, without this crazy overhead of now having to fill out a practice if they get an office space. So I totally get that piece. But there's this element of, it's almost like you're a Shopify for the dentist. But then because you have this real estate element to it, I would say you want an investor who understands that piece as well and can help you de-risk that.
Yeah, I appreciate that. A couple of my early angel investors are prop tech investors with real estate backgrounds.
Yeah.
Definitely too much risk for a traditional real estate investor for the first location.
Yeah.
Although maybe down the road when I'm building location 10, 11, 12, a real estate investor could be interested in providing more traditional debt financing. Help me.
Yeah, and that's the other thing is like the financing mechanism. You don't want to put venture dollars into that piece. Like the venture dollars are meant to like, you know, be the exponential piece. And so that's not supposed to be part of your real estate portfolio.
Right. Location one, you know, there's still CapEx that I don't think any venture investor likes putting money into. You know, $500,000 of dental equipment, for example, right?
Exactly.
And building out the space. But I think, you know, that's what I need for the first location, at least, while I de-risk the model a bit and de-risk my own execution risk.
Yeah. Next up, we have William Norwell with Paraclete.
Hello.
Hi.
So good to meet you. So I guess I'm on the clock here. So good to meet you. I've been following you for a long time. Tommy Leap's a good friend of mine. So blast from the past. He actually took my wife to prom, but we're still friends. Moving on a little bit. So to do this in 3 minutes. So I am the co-founder of Paraclete, which is the Greek word for advocate or helper, to come alongside in one's aid. And what we're trying to build is the world's first soul care platform. We're a pre-seed company. We're just finishing up our pre-seed raise. And we want to ensure that every worker can live an integrated life. And we don't think that's happening right now in the workforce. The mental health challenges are creating a giant disconnect where people work a third of their life at work, but they're just not thriving right now. And it's getting worse. There's the Great Resignation. There's data everywhere, right? Where people are just freaking out and deciding the grass must be greener somewhere else. So I have to go. And CEOs are figuring out that there's now a fourth, you know, there's medical, there's vision, there's dental, and now there's a fourth mental health category in health. And there's some great companies that have come alongside and done this, you know, in what I see as two categories. There's sort of the therapy and counseling networks. When you think of Talkspace, you think of Ginger.io, you think of BetterHelp, some of these things that are licensed clinical solutions for what's out there. And they really help you think through your past and figure out what those wounds are probably impacting in your current present day. And then there's some great companies, Thrive Global, BetterUp's a $5 billion company now, Bravely's more of a Series A company, sort of going into the executive coaching on demand for the companies. And we really think that helps you figure out your future. That's how to get that next promotion, how to get that next sales lead, whatever that may be. We're going to really focus on the present moment and really trying to come alongside in that moment and saying, hey, we just want to be here with you, walk with you. Like I said, what we call soul care, which is, I would argue that a human being at some level is made up of a body, soul, and a spirit, where the soul is really representing the mind, will, and emotion, your conscience. Your body is, of course, the physical. And then a lot of people think there is a divine presence. Some people do, some people don't. But we would argue we want to go help people figuring out how to be present and let companies have the opportunity to tell people we care more about who you're becoming than just what you do here. And our training program that we built with a couple of people that are kind of really well-renowned in what they do and helping people in their soul is helping exactly that. Come alongside and say, we care who you're becoming. And we're going to listen and through these sessions, through, of course, eventually our app and some of these things that don't exist yet. What we have right now is a marketplace of guides that we've trained that have gone through our program, and we're matching them with people. Today, you know, we've got 30 people on our beta platform. We've got 15 guides signed up that have gone through our training program, and we're ready to come alongside people and say, hey, let us listen to what's going on in your life, the unknown, unique life circumstances that just happen to all of us. And we want to remind people that I think the world's been trying to compartmentalize people for a long time, and that's just not going to work anymore. We've got to tell people they can bring their integrated self, their whole self to work and truly bring that with people. And so we're excited to do that.
We've looked a lot at coaching companies. We've looked at sort of mental health companies. And one of the things that we've had difficulty with is just sort of if you're selling particularly to employers, that channel is like really overwhelmed right now.
Yes.
They're overwhelmed with not just the mental health piece, but all of the other types of benefits that people are now pitching. And so I question whether or not that's the right direction to go in, because it's such a hard nut to crack right now.
Yeah.
And I think part of what you're going to need to do is really figure out how to position, and the positioning has a lot to do with the channel. And so I like sort of where you're headed and like why this needs to exist, but that's the piece that I would work on.
I think that's a fair point. No, and with your hard stop, I'll respect that and say thank you for the feedback, and I appreciate that. That's a great point.
All right, thank you so much.
Thanks, Anne. Thanks a lot. And Anne, just a final question. What's the best way for our community to keep up with your top of the mind thinking?
Probably on Twitter. That's where I'm Animaniac. Thanks, everyone.